Thanks so much, Todd, and thank you everyone for turning out today. It's been a terrific day of events. My name is Christopher Vecchio. I'm the Senior Currency Strategist here with Daily FX, provided by IG. We are a sister company of Nadex, and I'm here to talk to you today about trading the news, harnessing event-based volatility. Before we get in there, of course, I just have a quick few risk disclaimers that I have to flash across the screen. You're going to hear me talk for a little bit here while they do come across your screen. As always, any opinion that I disseminate is mine and mine alone. It does not constitute trade advice on behalf of Daily FX or IG Group or Nadex. So please don't treat it as such. If you do have specific comments or questions, you can always reach out to me through the Daily FX real-time newsfeed, stock tweets, and Twitter at CVecchioFX. So let's get started here. What are we covering today? One of the main questions that we get across our sales desks when clients call in is, what can we do to take advantage of XYZ event? It could be a Fed rate decision. It could be the US non-farm payrolls report. It might be something related to Brexit. But if it comes up on our economic calendar, we're getting questions about it. And so as the calendar turns into the second half of 2021, it's important to take a step back and reaffirm our foundation of knowledge with which we can operate for the remainder of this year. We're going to start off with an understanding of some basic concepts, what we want to trade. We're going to talk about risk management, the philosophy behind it, and more importantly, what we can do to take these lessons and turn them into actionable trading strategies. Now, when we start with basic concepts, we're starting with the question of why trade events and data. And actually, before we do so, I'm going to touch on a few behavioral concepts that you may or may not be aware of are influencing your decision making. When we talk about trading events, we're actually expressing our belief about the efficacy of different types of approaches to markets. What I mean by that is, in traditional finance, there's this concept known as efficient markets, which you can boil down to basically meaning that the price is right. Security prices reflect all available information in markets, and there's no free lunch out there. You will not be able to outperform consistently on a risk-adjusted basis. And there are three different types of efficient markets. Under the efficient market hypothesis, there's weak form, semi-strong form, and strong form. Consider the statement, the price is right, or, quote, prices reflect all available information, unquote. Weak form tests study the information contained in historical prices, and historical prices only. So you may be able to get an edge if you, say, examine publicly available material like a company's balance sheet or a country's macroeconomic indicators. You also may be able to use private information. Semi-strong form says that any information beyond historical prices, like what's publicly available, that's largely reflected. And the strong form, says all information, both private and public, is reflected in the price. So that means even if you have inside information about a company, material, non-public information, the market already knows it. There's no way for you to make a buck. Of course, that's unethical and illegal. And more importantly, for us as traders, we actually don't believe in any of these things. We don't think that there is no way for us to not have an edge, that we can have an edge by looking at technical analysis. We can have an edge by looking through companies' balance sheets, through countries' macroeconomic indicators, and discern some level of insight that will give us an opportunity in the marketplace. Of course, I think all of us would agree that if you have inside information about something, chances are you're going to do pretty well with making money on it. In fact, there's a real-world example last year that happened during the pandemic. Philip Lane, the ECB policymaker, after European Central Bank meetings in March and April, called up 11 different institutions and gave a thorough explanation about what was going on from the ECB's perspective. And after these phone calls from Philip Lane, these 11 institutions were seemingly inspired to take up positions in European sovereign debt, to go long Italian debt in particular. What happened less than 2 weeks after those phone calls? Well, the European Central Bank came forward and announced their bond buying program, and that was only 11 days after they had previously said they were not here to, quote, narrow spreads. So for the people who had access to Philip Lane, he called them up, he said, you know what, ignore what the ECB president, Christine Lagarde, said to you. Ignore what was just said to the markets publicly. We're going to be announcing a new program shortly, get long European debt. And those people did quite well. Every single institution made money on those markets that day. And this is just a real world example. And so if the market was really, this strong form efficient, then there wouldn't have been an opportunity for these actors to come in and take advantage of this information gap. So when you approach situations, If you are saying that you still believe in efficient markets, you're effectively saying that you don't believe in technical analysis that you're practicing. You don't believe in macroeconomic analysis that you're practicing. I'm going to add another layer on top of this. Has anyone ever taken a look at trading pits? Anyone knows what an open outcry pit looks like? It could be the Ring in London, which is actually now reopening, thankfully, or it could be the old Chicago trading floor. People wearing multicolored jackets, screaming at the top of their lungs, different hand signals, emotions. Does that seem like a rational environment? No, it's a high tension, high stress environment. So let's throw away the fact that we are operating in something that's completely efficient, right? We are not looking at a market that is predictable. It is not on a preset course. There is no time variance authority in the markets for those Marvel fans out there. Because we are a collection of individuals that are making decisions in different phases at different moments in time, because what may work for me today may not be suitable for you. And what I mean by that is what my investing and trading time horizon is could be materially different than yours. Why are we going here? Just think about this. Right now, I'm 31 years old. So if I'm buying stocks, this is not something that I'm, thinking about, will this put food on the table tomorrow? It's about whether or not I can use this as something to buffer my retirement savings for the next 30 years. There are also times when I take a look at trades and say, there's an options expiry this week. This may be something interesting to take advantage of over the next few days. But if you're, say, 45 or 50 or 65-year-old, you may have a different perspective. You may actually be thinking that the earnings that you've built up over the course of a lifetime and that you've saved and put into retirement accounts, you're now going to be relying on this more and more and more as your general cash flow. And so just that difference in time horizon and perspective actually influences our risk tolerance. It changes how we approach the market. Now, because everyone has a different risk tolerance in this collection, and that our aggregate of decisions form a marketplace, and because we have different approaches and expectations, when we get a piece of news, a speech, we all interpret those things differently. And so what we're actually looking for is not necessarily to see that we have a data release, a speech, an event that meets what the consensus is. We're actually looking for opportunities when we can look for large divergences between expectations and reality. If you think about this, the more disparate estimates are around a data release, i.e. non-farm payrolls, let's say the low print is 100K and the high expectation forecast is 900K. That means there's going to be a lot of people in there who have to change their position based on their previous expectation once the data is actually released. Let's also say that the report suggests that the range of estimates is only, say, 400 to 500K. That means a lot of people feel confident that we know what's coming. And so even if in both of those cases, the actual non-farm payrolls report comes in at 500K, one market requires a great deal of repositioning, which breeds volatility and therefore opportunity. And the other seemingly comes and go as a ship in the night that we soon forget about. Now, we really need to think about what's happening in regular market conditions. And quite frankly, the last time we spoke about this topic, we were not in normal market conditions. We were actually just coming off of the GameStop fiasco for all those diamond hands out there, people aping to the moon. We're now moving away from that a little bit. We're seeing crypto markets sell off. We're seeing that there's been a churn in asset allocation to suggest that traders and institutions are feeling like maybe the easy money period is coming to an end. So what we're looking for now is, as we go to normal market conditions, we're looking for shifts in government policy, changes in central bank action, and economic developments to drive price action. And so if we can identify the key event risks, we can not only make sure that we have opportunities ahead of us, but we can also help do our best to make sure that we are not on the wrong side of the market. Now, I will say something that I think Todd would agree with. I think that Michael Boutros and Brian Caprice, and really anyone would agree with if you spent enough time in markets. The goal necessarily day to day is not to make money. That's counterintuitive, but that's really the truth. The goal is to protect your capital so that when the opportunity comes, you are well positioned to take advantage. The reality of the situation is, and this may be heartbreaking to some people, there's actually no holy grail strategy to this. There is no, well, if NFP is coming, higher than expected, go long the dollar. It's not, if the ECB decides to cut rates, let's short the euro. There's no holy grail because, as I said before, we as a marketplace are an aggregate of individuals with our collection of decision making and expectations. And so we can actually see that our expectations ahead of time end up guiding the market reaction. What I mean by this is, how often do we see something like, looking at the daily FX economic calendar, which we will in a moment, there is an RBA rate hike scheduled. The consensus forecast calls for rates to go up from 0.25 to 0.5%. And sure enough, a rate hike is delivered. But at the end of the day, you look at your chart and the Australian dollar has actually taken a dive. It's fallen against the dollar, it's against the euro, against the Japanese yen. And you say to yourself, but I thought a rate hike was coming. The fact is that our expectation, the market consensus of there being this happening in the now and it coming to fruition, meant that the immediate focus shifted to what would be happening in the future. Is another rate hike coming? Is this the end of the road? Is the Reserve Bank of Australia suggesting that something else could occur? There's another greater risk down the line. And so because of this, because we are looking to see how the market reacts to the actual release, we're trying to measure that against expectations, we actually get a lot of whipsaw around individual data releases and events. You don't necessarily get the pure directional outcome right away. It takes time for people to reposition, to digest, to consider. Sure, this process has been expedited in recent years with the advent and implementation of algorithmic trading strategies, high frequency trading strategies that read news headlines, read data releases, and automatically reposition portfolios or trading accounts as a result of said events. But the initial reaction, that doesn't necessarily always reflect the true outcome, because let's be clear, we're living in a global marketplace. Particularly if you are an FX trader, you are looking at a global marketplace. You're looking at Asian currencies, European currencies, South American currencies, African currencies. You're looking all over the world to find opportunity, which means if something's happening here in New York at, say, 2 p.m. on a Wednesday, like the Federal Reserve meeting, it means that people in Asia haven't woken up to digest that news yet. It may mean that a lot of the European markets may not be paying attention. And so as the day goes forward, as the clock rounds, as the sun moves around our skies, we actually get a truer sense of how global investors, how the global marketplace will take this in stride and move forward. So for people like myself, when I'm looking at positioning my long-term portfolio, I actually like to reduce my risk going into these events so I can get a better sense of where prices are heading. But I reduce my risk so that I have a pile of capital to play with to see if I can capture some volatility around the event risk. And this isn't just me saying this. I'm not saying, these events breed volatility and now you're going to go off and march into the market and say, oh, I look at the calendar and these events coming and volatility is automatically here. But we actually have some tangible evidence. We have real-time data that shows that market participants do in fact respond directly to news events in particular. Okay, this is a chart from the New York Fed Liberty Street blogs pre-FOMC announcement drift, more recent evidence blog post. Now, there's something that you may say here. Of course, stocks rally into Fed meetings. No kidding, Chris. But we're not talking about the QE era here. This sample size is from September 1994 to March 2011. This is really before we went into that markets always rise around the Fed, the TINA trade. There is no alternative but to buy stocks. When we look at the cumulative returns of the S&P 500 around FOMC announcement days versus all other trading days, you can see that markets really aren't moving all that much in a 72-hour window. But when we have FOMC meetings, we actually get quite a little bit of volatility here. We get more significant moves in the S&P 500. The point of this is that market participants are responding directly to significant news events. And when there aren't significant news events, we don't get that type of reaction. So there is a reason to pay attention to this. It may mean that if you are someone who holds a long-term portfolio, you may be more at risk around big news events. If you're someone who's a short-term trader, however, this means that there is a bit more volatility, which means there is more opportunity. So we have to figure out what we can do to attack these moments in time, particularly as we head into more normal markets where volatility in general on a day-to-day basis seems to be diminished. What we can do to best position ourselves to attack the moments in time when we have this volatility. And so that's why we're going to talk about finding the right event and finding the right currency pair. This seems almost too simple, right? But in fact, a lot of people overcomplicate this. Before you even develop a trading the news strategy, you need to familiarize yourself with the key event risks that impact the major currencies. Just as an example, there are some central bank meetings that matter more than others. When we take a look at the economic calendar, I see the Federal Reserve and I see the Bank of England. I look at the European Central Bank, and I think, wow, those are really important events. Those are things that can move markets. But if I go look at central bank meetings for, say, the Swiss National Bank or the Bank of Japan, I get a very different feeling in the pit of my stomach. I think, oh, that might be a time for me to take a nap during the day, or spend time with my daughter, or go do laundry, because I know that the Bank of Japan and the Swiss National Bank are not that important in the scheme of the yen and the Swiss franc at present time. And so it's not a one-for-one fit. It's not simply this is a high-rated event. Okay, it's CPI for currency XYZ. Any CPI event for any currency out there is going to be market moving. Not always true. In fact, a few years ago, one of the major events that was moving data out of Japan were retail sales. Even though they really don't move markets all that much historically, they did so in a window for a few years because, in part, the Japanese fiscal authorities were increasing the sales tax. This was one of the quivers of Abenomics, right? And so the idea there was, well, if Abenomics is working, if the economy is as robust as we think it is, then yeah, there'll be a slight decline in retail sales, but eventually they'll rebound and people will just take it in stride. Well, that never happened. And so the way that the market interpreted those Japanese retail sales pieces, in fact, became more important perhaps than other Japanese data releases like CPI. So, searching through the slew of data as an individual trader, it can be a cumbersome task, admittedly. On the Daily FX economic calendar, any given week, we have hundreds of events from individual countries like Denmark or Sweden to the aggregate euro area. We have them from low-rated things like automobile sales or weekly jobless claims in an individual European country to something like the US GDP report. In any given week, we're talking about 100 to 200 events as we whittle it down that could be considered medium or high that ultimately might be something that drives markets. And so here's an example of our economic calendar. I'm going to pull up a live version in a moment, but you could see here that we have several different items. We have time, and this is obviously rooted to your time zone. I have it set to 0 GMT here. We have our countries and regions, and we have our importance level for these data. Here for this December 9th snapshot, you could see we have actual releases, the forecast, as well as the revised. And when we go to the live calendar, I'll click into one of these events so you can see the additional information, which would be a graphical representation of recent data releases, as well as a summary explanation about the report itself. But what I'm looking at here overall is the high, medium, low. And you may say to yourself, what high, medium, low, what? Why did you guys arrive at these color codings and these levels of importance? And I'll tell you why. Because they're based on empirical studies of how the markets reacted to data and whether or not people are paying attention. So we can break that down into two different segments. How does the market react? We bucket this out into basically, 10, 25%, and then a 65% bucket. 10%, the top 10% of all data releases that provoke the most volatility, the greatest price ranges thereafter, they're ranked as a high in that one column. If they're in that second threshold, if they're the next 25% in terms of realized activity following a data release, they're given that medium moniker. And then low, we come in with everything else. But on the important side for people paying attention, we actually can aggregate the data that we see for the number of alerts set cumulatively on the Thomson Reuters Icon terminal as well as the Bloomberg terminal. And we bucket them out in the same way. The number of alerts that are set, the top 10% of alerts set, those get the high ranking, and medium and low and so on. And so when we blend these figures together, we actually get an individual currency and country ranking for each data release. For example, when this says high for Australia, Westpac Consumer Confidence, what we're saying here is that this Australian data release, relative to other Australian data releases, it is in the top 10% of both people paying attention to it and in terms of realized volatility, historically speaking. Whereas this low number here, this may not mean much. And no offense to Japan or Denmark, but this slew of low-rated events, these are just the things that people are either not looking at, or if they are, they're just not seeing much of a market reaction there. And so as event risk traders, as people who are trying to take advantage of short-term opportunities in the market, this isn't exactly the place we'd want to be looking. And so I'm actually going to pull in the live daily FX calendar right now. You're going to see it pop onto my screen here just momentarily. And so if you're here on the Daily FX website provided by IG, that's dailyfx.com, you can head over to calendar and economic calendar. You'll see by just selecting today, you get the whole slew of events that have come out and that are yet to come out. And if we wanted to, we could simply say, let's get rid of all of the non-North American and South American data releases. And I only want to see the high-rated ones for the next few days. Well, you know what? Today there's none. Tomorrow we have one informed of the US, and over the next 7 days, they're actually only out of the United States. So this is informative. This is actually quite useful for us as traders, because if we are looking for opportunities within the North American currency realm, it would seem to be the case that it needs to be US dollar centric in the near term. Quite frankly, there aren't many high rated releases coming out over the next week, but moreover, there's not any other high rated releases for the Canadian dollar, for the Mexican peso, which means if dollar CAD or say dollar MEX moves, it's likely going to be from a US centric catalyst. So first things first, a lot of people say, well, I know that this data release, this event typically breeds volatility. And one of these currencies like pound yen or Aussie yen, they're typically the biggest mover. But the reality of the situation is that if we're not looking at a yen or pound, or looking at a Australian data release, there's no real reason for us to just try to look at the historical data and say, this is the most moving pair over the last month, and therefore, if I'm looking at US retail sales, I'm going to be trading Aussie yen. That's not really the right way to go about it. You're actually suggesting there's going to be a bunch of other knock-on implications, a bunch of other speculation that will occur within the currency space for the reaction to move away from the dollar and into the rest of the realm. And so, as I say, this seems counterintuitive that I have to even explain this, but some people try to overcomplicate this. A great example would be around NFPs. We're looking at US dollar pairs. We're looking at euro dollar or pound dollar to maximize the potential of seeing event risk volatility. I know some European-based traders, they trade euro pound quite significantly, but if you're only looking at euro pound around the US economic data, you may actually miss the move, because euro dollar could rise and pound dollar could rise, and on balance, this may mean nothing for euro pound. And as traders, we don't want to do that. We don't want to set ourselves up for disappointment where we tell ourselves, here comes the opportunity, I'm ready, I'm waiting, I'm psyching myself up, and then nothing happens. That actually can be quite detrimental for our approach, because all of a sudden then you begin to miss action. You begin to say, oh, I should have done something differently. So the next time opportunity comes around, I have to make up for my lost chance this most recent round. I'm going to use a little bit more leverage. That's not the right way to go about it, okay? And I caution against that, because that is a frequent issue that we come across, that we hear about. Traders who are frustrated by the lack of movement or activity or progress in their trading results, and so they inevitably try to scale up, and they scale up into risks that they are unfamiliar with, and it goes from trading to more or less gambling. And you don't want to do that with the money that you've worked so hard for, to save up, to set aside, to invest, to help become your nest egg ultimately, that leads you to a point of greater prosperity for you and yours. And so find a process. And that's what this is all about, finding the right process that we can repeat time and again, in a very boring fashion, but in a fashion that we know if we execute on that process consistently enough, we ourselves are positioned to succeed over time. All of this is to say that when we are talking about trading event risk, and we are talking about scaling up and sizing down and ensuring that we don't psych ourselves up to do trades that, or take trades that we normally wouldn't take, we're actually talking about managing event risk. This is a great section because this is not something that you're just going to hear from myself in this session. My colleague David Song publishes a report every day during the week called Trade the News. And each report outlines what he believes will be the most market-moving event over the next 24 hours. And he outlines a particular trading strategy on how one can manage their risk to take advantage of volatility in this marketplace. So there's a few things here. Like I said before, there is no holy grail. There is no one size fits all trading strategy. If you yourself are coming into this market just trying to, say, bring alpha to your overall portfolio, perhaps this isn't right for you. Perhaps this strategy that we're about to talk about isn't for you. Maybe you have a different perspective. Maybe you're the person who says, you know what, I do want to take calculated risk around specific events. I think I can have an edge in this market. I believe that I have the ability to overcome this nonsense about efficient markets, and I can exploit the markets for some profit. Then you need to worry about your capital, because at the end of the day as a trader, I have one fear and one fear alone, and it's called the risk of ruin. Risk of ruin is that I will no longer be able to play the game, which is why I say I'm not concerned necessarily about making money day to day. I'm making sure that I protect my capital so that I can continue to play the game. Risk of ruin is something that new traders in particular, and even some intermediate traders as they're moving into that part of their journey, don't really appreciate. Because as you move from beginner to intermediate, you've gained some confidence. You've got your sea legs under you. You know what you're doing. You can walk the walk. And unfortunately, it's that moment in time when you're holding your chin up high, thinking that you figured it out, that it's a good time to take a step back. I can tell you that there have been many times in my career where when I've been most confident, I've soon seen my greatest losses develop. And it's because of the fact that I've not adjusted to market conditions, because I have not changed my decision making. And ultimately, the change in my decision making should be, what do I have to do to continue to execute in this manner, not how can I continue to make more money. We are looking for consistent results at the end of the day. And so you may find yourself in a market where you're looking to scale your risk, you're looking to figure out how you want to attack a significant event, and you may decide it's best to stay away and wait until the data release tomorrow, the next day. But you want to have that confidence. You want to have that skill set at your fingertips. You want to have those tools in your toolkit. And so I want to go through the various steps here of how we're developing a strategy. And you'll find this outlined in the Trade the News report. This is typically something found on the Daily FX briefings page on our website. So selecting the right currency pair. Of course, before we even think about entering a new trade, we need to consider which pair could work best. We've talked about this previously, but typically the home currency of the news release should be in that pair, i.e. the US dollar will be most affected by US labor market data. But picking the counterpart is likewise significant. For example, I don't like trading dollar CAD around US labor market data because the Canadian economy happens to be extremely sensitive to the US economy. 20% of Canadian economic activity is tied directly to the US. 70% of their exports go to the United States. And so when we have the US economy, which is very reliant on consumption. About 70% of GDP comes from consumption. You get a strong US jobs report. That means consumers have more money in their pocket, which means we can afford to buy more stuff as Americans, which likely means we're importing more things from Canada. And if we're buying Canadian goods, that means we need to convert dollars to Canadian dollars. And so for the outside perspective, there's a reason why the Canadian dollar and the Mexican peso are often seen as proxies to US growth. Because if the US economy is doing well, so too should be its neighbors that are so closely tied to the hip of the world's largest economy. But this also goes for other pairs, right? Like dollar yen, for example. Dollar yen is a very interest rate sensitive pair. Why is this? The BOJ is doing something known as QQE with yield curve control. It's not necessarily to go into what that means, but the key points are they're not raising rates and they have set the yield curve to a very particular structure over time. And so on any given day, dollar yen typically follows what's happening with US Treasury yields. If we think about dollar yen, it's a ratio. All FX pairs are ratios. And so you can use, say, the ratio of US Treasury yield to Japanese government bond yield to get a similar type of influence, a similar type of explanation for what the relationship between the two economies is like. And so because JGBs really are static these days, if US Treasury yields go up, that difference, that ratio, US Treasury yields divided by JGB yields, that increases and dollar yen tends to follow. And the reverse, of course, is true. As US yields fall, we typically see dollar yen fall. The area that I like to look at on the yield curve for FX, it's not the 10-year, it's not the 30-year, it's the 2-year yield. The 2-year yield, according to the Bank of International Settlements, and the Bank of International Settlements is the central bank of central banks. The 2-year yield is the yield that shows or proves most sensitive or influential on FX spot prices. And when we say spot prices, that's what we're trading: euro dollar, pound dollar, dollar yen. We're not talking about forwards or futures. We're talking about the spot currency. So you need to know the context of the release. You need to know, is this something that's going to influence price action? Because will it have an impact on policy? And that's one more layer I want to go in here. When we talk about economic data on the calendar, in this market right now, markets are moving and proving sensitive to whichever way the wind blows around data releases, if those data releases are something that could impact central bank liquidity. And so for central banks like the ECB or the BOE or the BOC, which have single mandates geared towards price stability, when we look at producer price index, consumer price index, when we talk about input costs like commodity prices, anything in that realm tends to drive the euro, the pound, the Canadian dollar in recent weeks. But for the US dollar, we've actually seen some flat reactions around CPI because the Federal Reserve has a dual mandate, and they tell us that they're not just looking at price stability, but they're also seeking full employment. And the Federal Reserve has been saying for quite a few weeks, months now, rather resolutely, it's going to look through inflation because the labor market is still in shambles post-COVID. And sure enough, we've now seen that the dollar has been less sensitive to CPI reports, and it's been more sensitive to non-farm payrolls reports. So there's no exact formula. And that's why David Song actively discusses currency pair selections for various news trades in the Trading to the News report. So if you haven't read those, I would suggest today is a good time to begin. Now, the second point here is, when we look at the actual data, is the news better or worse than forecast? We need to have an expectation, right? We know what the market thinks. Do we agree with the market? Do we disagree with the market? Do we think that employment will be stronger than expected, weaker than expected? Everything is in context of what the market believes, not just what we think will happen. And so we also want to watch then, as the data comes out, the true reaction. If the news is, quote, better than expected, did the currency rally? Or if worse, did traders confirm that sense by sending it lower? Like I said before, with an example around the RBA, let's say the expectation was for a rate hike. And you look at your macro textbook and you see, oh, higher interest rates means a stronger currency. I'm going to buy the Australian dollar on the expectation that they're raising rates. Well, if we know it's the market consensus, a lot of people are probably positioned for that already, and markets are forward looking. So it's been priced in, perhaps to a degree. But moreover, what if the RBA comes around and says, this is the last rate hike, and in fact, in 3 months' time, we're going to be looking at reverse course, and in 6 months' time, we're going to cut again. All of a sudden, yes, we did get our one little rate hike here, but it didn't really mean much. In fact, this actually happened in actuality in July 2011 when Jean-Claude Trichet, then ECB president, raised interest rates. And quickly by the end of the summer, we heard talk that this was a mistake. And once he was out of his position and Mario Draghi came in Mario Draghi's first meeting in October 2011, he cut interest rates right away. And it was well before that happened that the euro started to decline. Once the market came around to the point of view in August and September, oh, the ECB is now signaling to us that they made a mistake, that they don't really want a stronger euro, that this imperils their inflation outlook. And so what we're looking at here is confirmation that reality is either meeting, beating, or falling short of expectations. If you see a strong US data release and it beats expectations and the US dollar isn't gaining ground thereafter, that may be a red flag for you. There should be some heuristic that you have among a relationship of asset classes, different currency pairs, different types of contracts, that you can say, okay, I know that the market is responding in a manner consistent with XYZ outcome in the future. And so if I think that's going to be the outcome in a day or a week from now, I can take this trade today so that this will appreciate or depreciate in my expected direction. And so I like looking through short-term timeframes when I'm examining the data releases. I'm looking at the 5, 10, 15-minute charts to see if we have some discernible pattern, some defined levels of risk with which we can then say this may be an opportunity to trade. If we find ourselves, say, dancing along a long-term trend line, that becomes a level of interest for me because that quickly could prove to be resistance, it could prove to be support, it could be a launch pad for a reversal or a breakout. And so sizing up opportunities around that event risk, around those significant technical levels, may help me around the course to finding the opportunity that I'm seeking. Now, one thing that I say here is that when we are looking to enter a trade, for these short-term trading opportunities, it's all about risk management. We are defining our risk. And so as a simple heuristic for that, let's just say we're entering a trade with 2 units, right? As we play short-term vol following the news release, we want to be able to close some of the gains that we have. The idea here is not to stake out the structural long-term position. I'm not looking to the FOMC meeting and saying, this is going to come today and I'm going all in and this is the money I'm going to keep invested for the next 30 years. No, the point of this is here's a trade I can take in the here and now to enhance my gains overall. And so I like doing this in a very defined manner, 2 units. That way, as we continue to advance, as we make our progress in the trade, I have an opportunity to take some off the table. So first things first, I'm in the market. What am I doing? I'm placing a stop loss for both lots of the trade. I'm going to keep a set target for one lot. I'm going to have an open-ended target for my second lot. Why is this? Because if the market goes against my opinion, I want to be out. I don't want anything to do with it. My expectations going in were wrong. I now just experienced a loss. I have these emotions going through my head. Perhaps it could be unlucky. Perhaps it meant that it just so happened to slip through my stop point and then reversed and went in the direction I wanted. So be it. Tough luck sometimes. But the whole point here is that we need to have a defined level where we can pull the ripcord and say, let's get out. It's also important to size up your stop relative to where the market stands in terms of volatility. If we're in a really volatile market, you may want to use less leverage. If you're in a really quiet market, it may mean that you want to use actually a bit of a tighter stop. Why would that be? Because if we have a really, really quiet market and we see recent ranges break, it could be that this is the trigger to start an intraday move that's working well against you. It could be the start of a move that leads to an unwind of positioning. Whereas within a really, really volatile market, if you're using a smaller position size, it affords you the slack that you need so that if markets remain volatile, you don't necessarily get knocked out by the whipsaw conditions. So having a filter for volatility to determine whether or not you should be scaling up or down is important. And if you're using more leverage, realistically, you need to keep a tighter stop. If I have two lots on with a 25 point a stop loss versus say one with a 50-point stop loss, my risk is the same, 50 pips altogether. But I'm going to be a little bit more sensitive to changes in price if I have more leverage on the table. So going back to the strategy itself, I like to place the stop at the same point in time, line in the sand for both lots. And then I'm setting a target for the first lot. And I'm leaving an open-ended objective for the second lot. And the reason being is that if we do ultimately achieve our first price target, we're going then to take profit on that first lot. And then we're going to move the stop up on the second lot. Why is that? Because it guarantees that even if the market reverses against us, we've taken some cream off the top. We've pocketed at least a positive trade, a profitable trade on our side. But it also may be the case that as price continues to advance, you find yourself with a trailing stop. We can't realistically know how far a pair will move. We can use technical analysis to get an idea, to make a probabilistic judgment about where things could end up and where they may reverse. But you do want to give some space for your trade to breathe, so to speak. So I use discretion for that second target. I like to set up my stop to that initial point where we got into the market. We've now taken profit on the first lot. Our second lot is open. The second lot stop is where we had entered altogether, thereby capping our risk at 0. And if we advance beyond, say, a threshold where I feel is comfortable with a second target, I will then start a trailing stop right at the point where I took my first trade out of the water. Why? Because worst comes to worst, that means I booked both legs of my trade at my first target. I walk away happy. And if the market continues to advance, I'm able to keep trailing up my stop so that I am able to lock in more and more of that move. At the end of the day, we are defining our risk at every step of this equation. We are not doing anything that leaves us open-ended, holding the bag on the other side. This is one of the points that you'll actually find in the Daily FX trading guides if you go through the IG Client Sentiment Index guide. But if you look at the aggregate of IG's execution desk data, which we at Daily FX, provided by IG, have access to, we've done measurements to see are traders more right than they are wrong. And for the average trader, they're actually right. 53% of the time, we're seeing that traders are making the right call. Long euro, short euro. They're right 53% of the time when it comes to that. But the problem is that for newer traders in particular, they don't know how to define their risk. So even though they're right 53% of the time, their average loser can be twice the size of their winner. Now, I'm a baseball guy, so I'm going to run through some numbers here for you. If you're losing twice as much as you're winning, if your losses are twice the size of your winners, that means you need to be right 67% of the time. 2 out of every 3 trades you have to get correct in order to just break even. But we know that's not the case. It's much more difficult to increase our correct ratio than it is to scale down our risk and get our risk management under control. So as a new trader, I like for people to think of themselves as baseball players. Think of yourself as someone who is trying to hit 300, right? The best baseball players in the world, they're getting hits 30, 35% of the time. You're getting hit 35% of the time in baseball. You're hitting 350. You're an all-star every year. You're a Hall of Famer at the end of your career. What matters is what happens when these guys step up to the plate, right? They're not just striking out. They're hitting home runs. They're driving runners in. They're advancing guys over to the next base. And so you as a trader need to think of yourself, I'm okay with being wrong. I care about making money. So if it means I take a small loss, a small loss, a small loss, and then I hit on that fourth trade, we want to make sure that we have a trading strategy in place that allows us to make up for our earlier losses so that we can afford to be wrong. And then once we master our risk management controls and we're okay with making mistakes, then let's focus on being more accurate. Because if we can keep our ratio of how profitable we are on winning trades static across time, let's say that we take 3 times the profit on winners than we do on losers, even though we're right only 30% of the time, and so we're basically breaking even. We're making no money. If we take that correct ratio back up to the average 53%, and we're still doing 3 to 1 on our profitable trades to our unprofitable trades, we're going to be in a very comfortable place soon. So risk management, defining your risk, how much capital you're leaving on the table, what's the worst case scenario? That is what you need to master from day one. And if you can master risk management, then the other things will begin to fall in place over time. The single best piece of advice I've ever gotten from anyone, and I've heard it from Todd, I've heard it from John Kickletter, from Michael Boutros, from everyone that I've ever worked with at DailyFX, IG, or Nadex. Who cares about being right? We just want to make money. And if that means we can make more money and we can take some smaller losses, that's humbling, but it puts us on a path where we can be confident in our processes and ourselves over time. So when we develop these strategies, remember, define risk. And if we can define our risk, we can control, at least diminish the downside that we experience. I hope that this was informative. You're going to hear a lot from myself, Michael Boutros, and others. We do this at DailyFX 24/5, actually 24/6, realistically. We highlight fundamental and technical items. We do live webinars, live streams around major news events like non-farm payrolls, FOMC. We publish weekly and quarterly forecasts. We also share news through social media channels, and we help provide IG and Nadex with complementary research and education. And so if you do have any comments or questions about my presentation, about any of the other presentations that you heard today, definitely feel free to reach out to myself, to anyone else that was here. We are here to help make you better decision makers, Todd, right? We want our clients, our listeners, to attack the markets with the best information possible so that they can confidently go about their day-to-day and have a sense that they're actually moving towards that path of prosperity.